Thank you for joining me. I'm Gridlock. A reminder before we begin, do not trade from any of these slides. They are commentary for educational and discussion purposes only. Always consult a professional financial advisor before making any investment decisions. In this month's LONGWave, I'd like to discuss the U.S. election and highlight what it means for investors and maybe more importantly, what it means for the USA. That has, until recently, been the unquestioned and acknowledged leader of the free world. Though the U.S. election results are still in dispute as we publish this video, the mainstream media and the Democratic machine has declared Biden the president-elect. This may very well turn out to be the case, but it has always been our approach that we strictly follow the facts. The fact here is that the law determines the president-elect, not the media machine. As such, there is a constitutional process of certification, verification, chain of custody, as well as the process of accommodating legal challenges, which results in Congress accepting the final Electoral College certificates of election on January the 6th, 2021. This is, in fact, when a president-elect is determined. Until then, our writing will reflect an undecided presidential election. You would expect no less of us, and therefore this discussion will reflect that, and therefore I apologize to those who think I'm raining on their parade, or I'm raising meaningless information, or they are reading yesterday's newspaper. Please do not try and read my political views into the following. As an investor, it is too expensive to allow political views to influence perceptions. I endeavor to deal only with the hard facts. Having said this, there are, however, many outcomes that are already quite clear and I believe profound, which must be understood within this context. As such, I'd like to discuss the subjects listed here. So what do we know with certainty about the U.S. election outcome so far? Well, we know there were some big losers who were not even on the ticket, which will likely pay a big price sooner or later. Credibility. The broadly forecasted and reported blue wave by media and their political pundits simply did not materialize. The pollsters and the mainstream media lost all credibility as reliable sources of information with both Democrats and Republicans alike. It was so significant as to now be accused of charges of outright voter suppression by unbiased observers. Financial exposure. The credibility of social media platforms is now also in serious question. As such, they were called before a Senate hearing during the run-up to the election. Stories and opinions by a broad swath of organizations and individuals were either removed or simply not reported. The failure to report the Biden family pay-to-play scandal was only one such blatant example. Frankly, it was not debunked as a smear campaign, at least to me, based on the fact that I immersed myself in the provable facts. Twitter, Facebook, and Google are now exposed to Reg 230 eligibility removal as a direct result of unprecedented censorship. This will not go away after the election and will likely foster regulatory changes, including the possibility of monopoly proceedings. Campaign contributions. The massive dollars spent on targeted Senate races was astounding. Senate leaders Mitch McConnell, Lindsey Graham, as well as Susan Collins saw well over $200 million of outside money targeted against them in their re-election races. This was unprecedented, of what I will call big money attempting to change the Senate. We are witnessing the growing powers of what I've long written about regarding crony capitalism. We saw crony capitalism blatantly exert itself into the public domain other than from the murky shadows in Washington lobbying. Socialism. The vast majority of Democrats rejected socialism and proved to be moderate in their beliefs. They believed that their party's control had been hijacked by the left wing of their party. Proof lies in the fact that overall Democratic votes only increased by well less than 1%. It lost seats in the House of over what many Democrat congressmen strongly expressed in a post-election caucus call as the party's apparent socialist shift. What we saw was a U.S. election rejecting socialism. Because of the Senate control remaining in Republican hands, we are fortunate that it has slowed a socialist shift in the U.S., at least in the intermediate term. U.S. constitutional framework. Because of the Senate control remaining in Republican hands, it has additionally stopped, again, at least temporarily, the erosion of the U.S. Republican constitutional framework, the packing of the Supreme Court, the removal of the Electoral College process, the removal of the filibuster, the dilution of the Senate by adding more seats. I'll come back to these points later in our discussion in further understanding the real meaning of this U.S. election. Frankly, it appears no one is happy, other than the markets. The radical left lost the Senate. Trump haters feel there was no blue wave. Democrat base are angry they lost seats in the House with no change in the Senate, as I said. Trump deplorables are despondingly feel they may have lost their only hope with a Trump loss. The Republican base is now totally disgusted with the system and sees it even more corrupt than they had previously suspected. The markets, on the other hand, reacted with euphoria. To me, the markets reacted to and applauded what they saw as the positive outcome of political gridlock. Political gridlock was the Goldilocks scenario to many of the political policy platforms becoming possible outcomes. The markets gained in election week only comparable to the 1932 election of FDR. Why is that? Let me explain. There was no blue wave. Therefore, there is now a new market narrative. The markets love gridlock, which has been a Wall Street staple for generations. The risk of higher taxes and more onerous regulations under a Biden administration have been averted. With Mitch McConnell's Republicans in the Senate acting as a check, markets don't have to worry about higher taxes. They weren't. Or deeper deficits, which they were actively hoping for a week ago. With cabinet secretaries facing confirmation by a Republican Senate, the Treasury Secretary will likely be people like Leo Bernard of the Federal Reserve and not Senator Elizabeth Warren, who is campaigning feverishly for the position. The new arrangement will be good because there will no longer be a need to worry about the capricious and unpredictable Trump. His bizarre interventions into negotiations over an extension of the CARES Act was just one example of the kind of behavior investors won't miss. Biden will also turn down the heat with China, which is fine by Wall Street. How well does the new narrative work? History suggests that stock markets actually prefer periods of harmony, when the White House and Congress are controlled by the same party. That is when things get done. It is only the bond markets that like gridlock because there is far less risk of excess spending, and it is a while since the excessive deficits deterred anyone from buying bonds. The real winner is the Fed. Bonds responded exactly as expected if gridlock is truly good for them. Yields dropped sharply. The curve flattened. This was less about relief from bond vigilantes worried about default risk and more about a bet that the Fed will continue to be the only game in town. With no fiscal help coming from a Republican Senate, there will be no inflationary pressures, or at least less. The Fed will have no choice but to keep propping up the bond market and possibly even resort to yield curve control. That, at least, is the narrative. While the yield curve flattened dramatically, it only really undid the blue wave speculation in the run-up to the election. It remains far steeper than it has been for most of the time since the corporate tax cut of early 2018. Its steepening trend remains intact for now. Similar points could be made about the overall level of both nominal and real yields and about inflation break-evens, down sharply, but not yet suggesting anything much more than canceling out a few days of unwise speculation. This might even make life easier for the Fed in the short term, as it removes a dilemma over whether to intervene to bring yields down. For the longer term, the Fed's job is getting harder, as it may not be able to pass the baton to the Treasury. Of all the scenarios we assessed going into the election, the three shown here were the highest probabilities. Clearly, the blue wave on the right didn't develop, leaving scenario 1 and 2. Both assumed Republicans remained in control of the Senate and the Democrats controlled the House. Both scenarios come down to a Trump presidency or a Biden presidency, which would then reflect in all likelihoods of actions through executive orders. Biden's reversing Trump's executive orders, easing regulations, Trump further easing regulations. No major tax changes. Biden doesn't get his $4.5 trillion dollar tax increase nor his $2 trillion new Green Deal. But he likely gets the U.S. back into the Paris Climate Change Accord. Trump doesn't get further tax cuts. Both are stymied from major legislative initiatives. The Affordable Care Act continues, assuming no changes as a result of the pending Supreme Court case. We likely can expect changes to retirement planning by either president. We're likely to see bipartisan stimulus bills targeted towards significant infrastructure spending. Assuming we do have a Biden-McConnell duet in our future, what are the likely longer-term effects? In brief, it is best to brace for a repeat of the trends we have all grown to know and love in the last year or so. With rates held on the floor and a deflationary, largely growthless environment, duration becomes the be-all and end-all. The FANG stocks have run dramatically because they are seen as reliably profitable, immune to the economic cycle. Low discount rates make their future earnings stream ever more valuable. So far this year, the FANGs and long-dated bonds, that is represented by the TLT ETF, have done far better than the stock market as a whole. Let's consider each presidential candidate in a little more detail separately. We'll start with Vice President Biden, who currently has the unofficial number of Electoral College votes to become president-elect if verified. A Republican Senate would try to block Biden's most sweeping policy priorities, such as an aggressive economic stimulus package, Medicare expansion, and higher corporate taxes. In this scenario, Biden might have to expend significant political capital to nudge even modest proposals over the finish line. Since a COVID-19 relief package was not reached before the election, a Republican-held Senate is unlikely to pass a generous version in 2021, potentially spelling trouble for companies counting on increased consumer spending to get back on more solid economic footing. On the other hand, a divided government could have the opposite effect. Perhaps it would push both parties to the negotiating table to iron out key pieces of legislation. Healthcare. Obamacare continues to enjoy support among voters despite initial opposition. Some Republicans endorsed the program's most popular provisions, such as protections for people and pre-existing conditions, and the stipulation that young adults can stay on their parents' health plan until age 26. With Obamacare looking solid, we anticipate healthcare stocks will benefit. Financial services. With Republicans in charge of the upper chamber, financial services companies would probably escape additional oversight. One exception is the Securities and Exchange Commission's Regulation Best Interest, Reg BI. Reg BI went into effect on June 2019, but critics say it doesn't go far enough in eliminating brokers' conflicts of interest. A Biden-appointed SEC commissioner might replace Reg BI with stricter fiduciary rules. Technology. Both Democrats and Republicans believe big tech has monopoly power, yet they disagree about how to regulate those firms, and that could prevent the introduction of any meaningful tech regulations. Trump's major domestic priorities in a second term are unclear. The Republican Party did not unveil a new policy platform at its convention in August. In any case, markets may not be looking for ambitious legislation from the Republicans. The priority is economic relief from the impact of COVID-19. In this scenario, we don't anticipate a sweeping stimulus plan because there aren't enough Republican votes to push it over the finish line. On the other hand, Trump and a Republican Senate would likely seek to make permanent the temporary tax cuts introduced in the Tax Cuts and Jobs Act of 2017. Many of the provisions that lowered taxes on middle-income earners are set to expire in 2025. If Trump wins a re-election, he is likely to continue to impose tariffs on Chinese imports, especially given the deterioration of the U.S.-China relationship over the last few months. While it is difficult to predict just how big the next round of tariffs would be, it is not unreasonable to assume it would be roughly the same size as the $70 billion in tariffs currently in place. Industrials. Manufacturers were already scrambling to diversify their supply chain outside of China after Trump's initial tariffs. New tariffs would disrupt global supply chains further. While retail companies were able to pass along higher costs to their customers, industrial manufacturers have and will continue to struggle with pressure on margins and to absorb the cost of tariffs. Agricultural products like wheat and soy could also see a collapse in demand. Fossil fuels. Trump would likely loosen environmental protections further in a second term, but it is unclear if the benefits to oil and gas producers would be sufficient to offset global slump in demand due to COVID-19. Let's switch gears to the most important issue on the table for either potential president, the imminent and paramount need for fiscal stimulus. Without more stimulus immediately, the consequences are grave for a serious double-dip U.S. recession, and more importantly, the lives and families of millions of desperate U.S. citizens who, through no fault of their own, are quite literally without food except for what charity food banks are still tenuously able to provide. GDP growth will probably turn negative again in the first quarter of next year, if not sooner. Corporate and household bankruptcies are likely to increase even if there is a second round of stimulus. If there is not a second round, the number of bankruptcies will even be significantly higher. With bankruptcies likely to rise, it will become more difficult for the private sector, both households and businesses, to obtain credit. It's possible the credit to the private sector could begin to contract. Without another large round of stimulus, government borrowing might not expand enough to offset reduction in credit to the private sector. Credit growth clearly now dominates economic growth in the U.S. The wealth of the country depends to a large extent on the amount of credit that exists. More stimulus is essential. If total credit contracts, the economy will fall into a severe recession or worse, and a great deal of wealth is certain to be destroyed. Therefore, another large round of stimulus is essential for the country's economic health, future prosperity, and even national security. An austerity-driven, protracted U.S. economic slump would enable China to leapfrog the United States to become the world's leading economic, technological, and military superpower, even sooner than now appears likely. More than wealth is now at stake. Let me be clear. I'm a fiscal conservative, but this is not the time for philosophy. It is time for survival and immediate action. The country and its economy is unknowingly hanging on a knife's edge, mesmerized by the financial markets and a rebound built on the first stimulus and the major monetary facilities enacted. Austerity is the 21st century equivalent here to bloodletting. It's more likely to kill than to cure the patient. Only additional government debt, financed with additional money creation by the Fed, can prevent a renewed economic downturn. The first round of stimulus worked. The second round would also work. Your wealth, and much more than your wealth, is now currently at stake. To me, the real outcome of this election is something more profound on what is happening in the U.S. We witnessed the rejection by the American electorate of socialism and the tinkering with the U.S. constitutional framework. It was a win for the U.S. separation of powers, a win for checks and balances it instills, a win for the protection of minorities versus majorities, which the U.S. constitutional framework beautifully ensures. The election was not about whether your views are on the right or on the left. It was about how you viewed your personal freedom versus your economic freedom. I've used Nolan diagrams many times over the years to highlight this specific point. Politics is more than right or left. It is about the freedoms you are willing to surrender or refuse to surrender to maintain personal freedoms or achieve economic freedoms. We have witnessed over the last 20 years the rising power of crony capitalism and their use of methods such as regulatory arbitrage for competitive advantage. We saw clearly in this election where big money, big media, big technology are willing to blatantly act in the way many of us witnessed because of the nature of our backgrounds and how we spend our days. Fascism is closer than many imagine. I believe we temporarily pull back from that worrying precipice. I have labeled here where I believe the policies of both presidential candidates were centered from a historical frame of reference. I challenge you to independently make your own assessment. So what are our conclusions? Our thoughtful forefathers may have saved us from ourselves. The next 2 months may prove this even more so. The government's actions regarding stimulus may show us whether the governments today are so politically polarized that they can no longer operate in the best interest of its citizens in a timely and also effective manner. There are ramifications of ineffectiveness that government and elected officials must be held accountable for. I stress the word accountable. Time will tell, and that may be sooner than we fully appreciate. As I always remind you in these videos, remember, politicians and central banks will print the money to solve any and all problems until such time as no one will take the money or it is of no value. That day is still in the future, so take full advantage of the opportunities as they currently exist. Investing is always easier when you know with relative certainty how the powers to be will react. Your chances of success go up dramatically. The powers to be are now effectively trapped by policies of fiat currencies, unsound money, political polarization, and global policy paralysis. I'd like to take a moment as a reminder, do not trade from any of these slides. They are for educational and discussion purposes only. As negative as these comments often are, there has seldom been a better time for investing. However, it requires careful analysis and not following what has traditionally been the true and tried approaches. Do your reading and make sure you have a knowledgeable and well-informed financial advisor. So until we talk again, may the remaining part of 2020 turn out to be an outstanding investment year for you and your family. And I sincerely thank you for listening.